Yeah,
Thank you, sir.
sure. So we'll begin in
That
three,
we can
two,
start. Yes, please.
one. Good evening and welcome to the World Investor Meets 2020. On behalf of the Center for Capital Markets and Risk Management, IL&FS, in association with the National Stock Exchange of India and the Securities and Exchange Board of India, I welcome you all. The speaker for today's evening is Mr. Manjit Singh, Vice President, Corporate, Way to Wealth Securities Ltd. Mr. Manjit Singh has been associated with various financial firms like Punjab and Sind Bank, BgSe Financials Ltd, Ludhiana Stock Exchange Ltd, IL&FS Investment Securities Ltd, and HSBC Group Company, and Karvy. He is currently working as the Executive Director in the Bangalore Stock Exchange Ltd. We welcome you, sir. The topic for today's webinar is Do Investors Gain from Tips? The webinar will be followed by a Q&A session. The chat window will remain switched off throughout the webinar. Thank you so much.
Thanks, Anish. I welcome the participants to this webinar, and I'm extremely grateful to India Institute of Management, Bangalore, and National Stock Exchange of India, and also SEBI for providing me this opportunity to interact with the participants. The topic is that do investors gain from tips? Do investors gain from tips? It is a very interesting topic, but very sensitive. Normally, tips are presumed to be the investment advice or signals to buy and sell shares, which are provided by the insiders or deemed insiders who are privy to the unpublished price-sensitive information of a corporate. Before I start this session, I want to give two disclaimers. First disclaimer is that whatever views I express here are my personal views, and they do not necessarily represent the views of my present employer, which is V2 Wealth Stockbroking, or my past employers. Second disclaimer is that I have been in service with the two stock exchanges as executive director, and thereafter I served three institutional broking houses in senior positions. So throughout my career of 23 years, I have been subject to the employee trading policy, and as a consequence, I am very small-time investor and very conservative. Have been a very conservative in approach. So whatever case studies I have taken up in this presentation, they are not based upon my personal experience, but they are based upon the information which I received from other market participants, and the information given by them may not be 100% true. And what I am presenting in this session is the view from the gallery, which may not be accurate to the minute details. So with these disclaimers, let's start this session. We assume an hypothesis that investors do gain from tips, right? And we'll test this hypothesis across various time periods, starting from our journey from the period of early 90s when SEBI was just established. Okay, let's go ahead with this session. Now, the flow of presentation will be that we'll be starting from the stock markets of 90s. Then we'll go through the reforms in the capital market. Then we'll take up the case studies. And after taking up the case studies, we will just glance through the SEBI regulation on insider trading, SEBI regulation on research analyst. And thereafter, we will come to the current topic of objectives of investment, day traders versus long traders, clues of how did they invest safe and stay safe. And finally, we'll conclude whether the hypothesis which we are testing across various periods of time is true or false. Now, we enter the time machine and go back to the stock markets of the 90s. That was a very relevant period, reason being the SEBI was established in the year 1992. And before establishing a SEBI, the stock environment in the stock market can be summed up through a one-liner that they were broker and promoter friendly but non-transparent. What was happening at that time? Trading was through outcry system. I mean, the brokers assembled in a trading hall, which closed doors, and they would, transact the sale and purchase of securities by shouting at the highest pitch of their voice and through hand signals, supplementing their action through the hand signals. The investors who had placed in orders through the brokers had no clue at what rates their orders were being executed. At the most, they could peep through the glass window into the trading hall, but they could not get any idea what was happening inside. Other problem was that at that time, the securities were in physical form. Shares were issued in the form of physical certificates, which were very difficult to store and retain. And then, if they are sold, the seller would put a signature and give it to the buyer. Buyer and then it will change many hands, and finally, they will be signing the transfer deeds also, and finally, the deed will be submitted to the RTA before the closure of, the books of the accounts of the company. And there, many times, the RTA will find that there is difference in signature or there are other irregularity or deficiency in the documents, and will return that transfer deed as a bad delivery. So what was happening? People were not able to get their securities transferred, and crores of rupees were struck up in form of bad deliveries, which ultimately the investor has to lose. Then the settlements were for a period over fortnightly, monthly period. Rather, I would say that these were perpetual settlement because supplemented by the Bavla system, the people, the brokers could carry their positions for months together, and by paying a small amount for Bavla. So it was ultimately the seller choice when he wanted to submit the securities and deposit the securities so that they would be ultimately transferred to the buyer. Exchanges were broker governed. The board were purely comprised of the brokers, and even the committees, including Investor Grievance Committee, comprised of brokers. There were very lax brokers or broker regulation. The capital adequacy, other norms, they were not quite adequate. And there have been instances where the investors have traded to brokers, they have given them orders for purchase or sale, but they could never get back their money from brokers, and many sub-brokers simply evaporated from the scene. Similarly, there were weak controls over primary market. In the primary market, the issues which were brought by the issuers, they took almost 70 days to get completed. Allotment of shares were done through formulas which were decided by broker-driven committees, and there were many irregularities. The applications submitted for allotment shares were checked at stock exchange level by a broker committee, and there were a lot of complaints of unfair allotment of shares. What I would like to say that basically it was a broker-driven exchanges which had a broker-driven, the systems which were advantageous to the brokers, but had a semblance of investor protection, nothing more than that. That was the time when any primary issue was brought in the market, the there was the flow of insider information between promoters and brokers and operators, so-called operators, I think big brokers who are able to manage the markets. And a lot of insider information was flowing through informal channels. And people at that time, they believed that the money could be made in the stock exchange only if you have the tips from a reliable broker or a company executive or something like that. That was the belief at that time the people had. Now, the next slide, we'll take look at the reforms in the capital market. When SEBI was established in 1992, there were a plethora of reforms. The first reform, I would say, was initiated with the establishment or with the commencement of trading by NSE itself. It started trading in November 1994, and it was the first exchange to start screen-based trading in India. Other good point about NSE was that NSE was not a broker-managed exchange. It had independent professional management and very transparent systems. And they were user-friendly, investor-friendly. The settlement across the exchanges was gradually reduced from fortnightly settlement or monthly settlement to T+1 settlement, which is also known as rolling settlement. Now, today, if you are buying shares and you have placed the order today, day after tomorrow, you'll get those shares in your demat account. And if you are selling shares, day after tomorrow, you'll get money into your bank account. Other revolution which happened in this capital market was the introduction of this dematerialization of the scripts, basically conversion of physical securities into electronic form. This revolution helped the investors to conveniently retain and maintain their shares, and it also facilitated instantaneous transfer of shares from buyer to seller. Sorry, the seller to buyer. Other reform which added to, enhancing the transparency of systems was that earlier in the outcry system, the brokers were trading in their own account, and finally they were allocating the trades to various orders placed by the clients, which were totally non-transparent. But SEBI asked the brokers to register their clients with the stock exchanges by allocating them unique client code and place the order at client level only. Now a client can easily find out what rate his order has been traded. And he, not only from the broker, he also get confirmation from the exchange on which the trading has happened. Demutualization of broker-controlled stock exchanges. This was done by SEBI to free the stock exchanges from the control of brokers. Professional management was introduced in all the stock exchanges. The board was managed by independent directors. The systems introduced were very transparent. Investor protection was taken up in letter and spirit. The investor grievance committee or arbitration committee, they were having members from, the people who had knowledge about the market, who were legal luminaries, and who were also having financial background. So they provided just and fair decisions on the basis of where there was a dispute between an investor and a broker. This also was followed by reforms in primary market. Earlier, you know that it used to take 70 days for listing of a share, completion of listing process, then it was reduced to 42 days. And with the reforms in the primary market, raising of capital has become very convenient. I would say that this made, the book building process introduced by SEBI has made the price discovery very transparent and also very convenient. The listing happens in just a matter of 10 to 15 days. SEBI also mandated through various regulations better disclosure from the promoters in the offer document. And book building, I would say rather that it enhanced the efficiency, not only the efficiency, but also helped in optimizing the cost of raising capital. This slide will show you what kind of developments which happened in secondary market, just in a graphical mode. Now, we went back to the period of early 90s, mainly because we were of the view that the investor at that time believed that there were tips from the insiders, and if money had to be made in the stock market, then it is essential to have those tips. And without those tips, you are just playing on your luck to make money in the stock market. Now, we will take up the case studies just to have a view that what happened in various periods of time and how these tips worked, whether they worked, they guaranteed assured return to the people who received tips and acted upon these tips. I'll take up 4 cases here from various periods of time. First case relates to Vice President of a regional stock exchange. I joined Ludhiana Stock Exchange in March 1996. But my interview was held in the month of November 1995. The interview committee, the selection committee, comprised a SEBI official, 2 independent experts, and vice president of that particular stock exchange. That guy was really smart and very knowledgeable. And he was the guy who asked me most of the questions. When I joined the stock exchange in March 1996, the first meeting of the board was held within 2 days of my joining. To my surprise, I found that vice president was not there. He was absent. Later I learned that fellow, who was vice president of the stock exchange for the last 3 years, was sitting on a notional profit of around 2.6 crore, and he wanted to reach a coveted figure of 3 crore because he was in the process of buying a hotel which was available at that time for 3 crore, and he did not want to raise any loan for purchasing that hotel. But in the process, that fellow not only lost his notional loss of 2.6 profit of 2.6 crore, but also the securities which he has deposited with the exchange, and it also led to auction of his car. He couldn't meet his payout liabilities, and it ultimately led to auction of the car, which was sold for 50 lakhs. And the fellow thereafter never came to the stock exchange. Now look at this case. That was the time when the exchanges were broken clean. The guy who was a powerful functionary of his exchange. And he had close relation with many promoters. And he also had networking with big brokers of Delhi, Bombay, and Kolkata. It means that who are, so-called operators. Yet he was not able to sustain the notional profits which he had made. It means he was not able to get the benefit of the tips. And the fellow lost his entire money in the process. But there could be a counter argument also that the initial money he made, the profit, notional profit which he could not book and which he made was also based on the tips. So that kind of argument will be there. So we have to just look at this, analyze it, that in the final test of the hypothesis. Second case relates to the promoter director of a issuer company which listed its IPO in the year 1996. If you look back at the statistics, you will find that around 1,426 shares were listed in the financial year 1995-1996. That was the maximum number of issued listed in any financial year till today. That time, what was happening? There were a lot of, I would say that after this Harshad Mehta scam, there were a lot of excitement in the market. The reason being that although that scam exposed the weak market systems and also the banking system, but there was a blessing in disguise that by reading the newspaper coverage, the people came to know of the mechanism of stock market, and for the first time, the investor realized that the shares could be traded at 100 times of their face value. The valuation could go to 100 times of their face value. So, like SBI traded at 25,000 and ACC traded at 10,000. So, which was having a face value of what I should say, just 100 rupees. So there were a lot of excitement in the market, and all these shares, were being lapped up by investors who are eager to make money through the stock market. In that scenario, one of the promoters brought his issue, and issue was oversubscribed, and it's open for trading at 8 times the face value, the issue price level. And the price was going up. This promoter director, he received a lot of requests from his friends, from his relatives, and from the fellow brokers and the brokers he knew, asking for shares through off-market deals, so that those persons could also benefit from this IPO. The demand was so much that this fellow thought that he is sitting on a gold mine. Forgetting that, at that time, there were issuer and operator nexus, and the market was operator driven. Under this impression that he was sitting on a gold mine and he should wait so that he can make more money, he retained 90% of the shares. And today those shares are being treated as penny stocks. Now this is case of 1996, where a promoter director, who can be better insider than a promoter director, who had not only access to the published results of the company, but also to the unpublished results, because they sit for review and other things. And he also knew that there is a nexus of issuer and operators. Still, he could not make profit out of that, and he lost money, whatever he invested in his company. Now we move to year 2001. That was the year which was the era of dot-com industry, telecom industry, and the shares were growing at multiple of PE values. I mean, extraordinary PE value, multiple of PE value. At that time, the second big bull of the market emerged, Mr. Ketan Parekh. He has his favorite basket of stocks, which was known as K9. And he preferred to trade through selected brokers. Brokers of BSE, brokers of Kolkata Stock Exchange. Now these brokers, he was placing his orders for sell and purchase in bulk quantity through these brokers. One of the Bombay-based brokers had his brother in Ludhiana. Now this fellow was getting tips from his brother that whatever shares Ketan Parekh was buying or selling, he used to get information from brother and he would replicate those orders in form of sale and purchase of shares. And also, he would place orders for his clients who had entrusted their money with him. And these clients happened to be the police officers and income tax officers of the city. Later, when the bubble burst, there were problems in the stock market because it's a rare instance that when one of the regional stock exchanges had defaulted in meeting the payout. I mean, normally at present NSE, BSE, they guarantee the settlement of case to trade guarantee fund and other means. But that was at that time, Kolkata Stock Exchange failed to meet the payout liabilities of the brokers who were obligations of the broker who were to receive money. So what happened? This guy also lost a lot of money. He had to sell his bungalow to make up the losses, but even that was inadequate. And in another 3 days, he had absconded from the city with his entire family. Now there is a case that fellow is having tips, not the hearsay tips, but the exact, tips that what this big bull was trading. Still he could not make money. And he has to run for his life. Now let's move further. We'll move to the year 2007-8. If you remember, there was markets were very excited and there was a bull run in the year 2007. The market touched a new peak. At that time, everything was going well, but suddenly in 2008, that meltdown happened in USA because of the subprime mortgage issues. In 2007, many of the shares were going up, and it also, the company in the real estate business, they were also growing up. This case relates to CEO of a company, a real estate company, which were doing very well. And even today they are doing very well. It is a very ethical company. They have a lot of projects. Its earning was improving, its margin was improving, its profit was improving. And this CEO of the company at that time had received around ESOPs worth 10 crore. And in addition, what he was doing, he was buying shares from looking at the improvement in fundamentals of the company. He was buying the shares of his own company from the market by investing his own money, own saving. In order to leverage the position, this fellow had taken loan from an NBFC, which he thought that he will pay once he is able to exit of these positions at a handsome price. In order to recover the money lent by the CNBC, we had to sell shares of this fellow gradually. And finally, what happened, he not only lost the entire ESOPs, but also a substantial portion of the shares which he brought from his own savings. Now again, look at a person, CEO. CEO of a company, who can be better insider from him? He knows what is happening in the company, what is the performance of the company, and how things are moving in the company. In spite of having this information, he could not save his own investment, reason being that he could not control the external factors. Now we move to next slide. To change the mood of the participants, now we'll take up some cases where the people were winners from the tips. The first case relates to a broker who was mainly doing proprietary trading. This fellow was a CA by qualification, but he was not doing any CA practice. He was a small-time broker, but he made good money in the market. Once I asked him that you don't have clients, too many clients, then how you're surviving? He said, I am not surviving on the basis of my client trades, but I am doing my prop business. Now, how are you earning money in the proprietary trading? He said that I'm in touch with many big brokers of Delhi, Bombay, Kolkata, again, so-called operators. I'm getting tips from them. But I am not simply relying on those tips. I have my own study. And with passage of time, I developed the sixth sense that when I sit in front of the screen and see the BPO, my sixth sense tells me which are the shares which will part of the bull run and which are shares where the prices will go down. And I accordingly take positions on my own count. Other thing which he said that I am very disciplined trader, because when I have profit-making open positions, I retain them for earning more profits by gradually increasing the stop loss price. But where I incur a loss, I have a loss-making position, I'm very quick to close that position by booking the loss. This fellow was later joined by his father, who retired as chief medical officer of a government hospital. And then he also made his brother, who was serving as a sub-divisional engineer in irrigation department, to resign and join him. I met this fellow around 5 years back. Today he's sitting at a net worth of 300 crore. So the question is whether this fellow made money from tips only. In this case, he not only utilized the tips, but also had his own study and a very disciplined trader. So that gives us that winners are not simply based on tips, but they have other qualities also. Now, we go to year 2003. That was the time, if you remember, the clients and investors, there was excitement in the market and they used to, glued to CNBC and other business channels. And even in the night, they would see what is happening on Nasdaq, and they will wake up till late in the night. And the next day, they were again present early in the stock exchange to start their trading. At that time, I found a person who was member of the stock chain. And he had clients also, but he was never trading. I once asked him, "You're not trading?" He said, "That's my choice." Anyway, that fellow was driving expensive cars and he was also having, luxurious lifestyle. Then I asked one of his friends, "This fellow is not trading, from where is making money?" That fellow told me that this fellow is a cousin of a fund manager who is based in Singapore. That fund manager was very popular and he used to regularly appear on all business channels. So this fellow was getting tips from that fund manager in the morning, early morning itself, that what kind of trades that fund will do, what shares it will buy, and what shares it will sell. This smart fellow would pass on these tips to his clients and to his broker friends at a cost, at a price. He himself never traded, but he has made money by selling these tips. So this fellow, again, proved that money can be made from tips. And this was a short winner because he never utilized those tips. He never took a risky position based on those tips. Now, I request the participant to be very attentive because I am now going to disclose one uh, tip which can sure shot get you money from the market. This tip is a winner of the winners. You know that there are FIs and the mutual funds which trade to empanel brokers. These empanel brokers have specialized institutional desk, especially dealers who trade through institutional desks. Under the SEBI guidelines, no mutual fund can transact more than 5% of his business through a single broker. Naturally, most of the mutual funds would be having more than 20 empanel brokers. Now these brokers, they have a specialized trading desk which is managed by these very specialized, very efficient dealers. When a dealer gets an order from a fund which is for a bulk quantity, it may be a buy or it may be a sell order, he gets a fair idea that once he will execute this order, the price of that particular script, if he is buying, will go up, and if he is selling, it will go down. Some of the smart dealers, they passed on this information to their relations and their friends and our associates, who in turn, took up the position in the markets before the dealer executed the orders. What they will do if dealer is buying shares, that particular script, these associates will buy in the morning, and after the execution of trade by the dealer, order by the dealer, the price will go up and they will scare it up by booking a profit. Similarly, if he is short selling, if he's selling something, they will short sell and they scare it up in the evening by buying that security. 95% of the time, this was a winner. But be beware, there are two catches here. First catch is that the brokers and panel brokers who are having the specialized institutional desk, they don't allow dealers to take their mobiles inside. They are asked to leave their mobiles outside before they enter the enclosure which houses the institutional desk. The orders are received on landline, and all landlines have the system of voice recording. Even if a smart dealer passes on this information to his associate through some means, the second problem is that SEBI has a very rigorous surveillance system which provides it online real-time data across all the stock exchanges, and which was introduced in the year 2007. And in the initial year itself, it detected many cases of front running, and the employees and those AMCs or the brokers have been heavily penalized. Now, these were some of the cases we tested across various periods of time. Now, another thing is that is SEBI aware of that the abuse of insider trading happening in the stock exchanges? The answer is yes. SEBI always apprehended that there would be insider trading through the nexus of promoters, brokers, or operators. So, in the year 1992 itself, the SEBI brought out the first regulation prohibiting the insider trading. This regulation there were a lot of amendments which happened to this regulation, and finally we are in the year 2020, another amendment was made. The basic element of this regulation are that this is applicable to listed companies and securities proposed to be listed. And here the insider is a person defined as a person who is connected to the company, maybe the employee, maybe the chartered accountant, maybe the company secretary, or is in possession of or having access to the unpublished price sensitive information. Possession of information means that he is one of the employee or somebody else, or he have by accident or by design received that information from the company, and he is utilizing that sensitive information to make gains. So the components of insider trading are: first, the prohibition on the communication of UPSI, the unpublished price sensitive information, by insider. Second, the provision on the procurement of UPSI by another person. And third is prohibition on trading by insider while in possession of UPSI. Now we'll go to the next slide. Here the research analyst. What happens that the people who are into regular research, they go to companies, they take their information, they analyze the information, and sometimes they also become privy to price sensitive information which had not yet been published or made public. This regulation, which was brought in year 2014, it has provision for registration of research analyst. It defines what can be the qualification and certificate requirement for research analyst. And they have to also disclose the conflict of interest. And there are systems defined for publication of reports and what kind of disclosure they have to make once they have public appearance on media channels, and how these reports are to be distributed. So we have glanced through these two regulations which SEBI enacted because they knew, and they also apprehended that there will be the abuse of these insider information in the market. Now there is a participant may have a question, dear. Once SEBI knows it and the system has been strengthened so much, then why we are discussing this topic today? It means that markets have become so perfect that information is reaches public in time, and people who get a research report and they can utilize those reports and they can make money from their own study and other thing. Of course, they will get gradual returns and they will be able to make long-term investment. What's the need of discussing this topic today? So I will give you some data. Thereafter, we take up what was the reason of taking up this topic today.
If you see the data which I got from some of the newspapers and news reports, from the month of April till September, there were either complete lockdowns or partial lockdowns, which were triggered by this pandemic of COVID-19. But what we find, to the contrary, that although people were staying home and there were a lot of hue and cry about the business, yet the DP counts during that period increased from 40.8 million to 45 million. That's a net increase of 10%. Another thing which happened, that FO volume on NSE, they increased from average of 11 lakh crore to 25 lakh crore. And cash volumes on NSE alone, they increased from average of 50,000 crore to 58,000 crore, a registered increase of 16%. FO volume registered increase of 130% in this period. There are several reasons. The people are saying that reasons are that why people have become more interested in the stock markets and the capital market, reason being they lost faith in other categories of assets due to lockdown. And some people are saying that since people were working from home, so they found it easy to trade. And there's another interesting hypothesis, or the reason given by some of the people, that many people lost their jobs. And once they lost their jobs in different sectors, they decided to do something to earn money, and they switched over to this style of trading. I mean, they became active on the stock exchanges, stock markets. No. Am I sounding a caution? No. Reason being that traders are must for a, sound stock market. Without these traders, the liquid will be impacted and the impact cost will become much higher. If you look at delivery percentage of cash trades on NSE varies between 10 to 30%. It means that out of the 60,000 crore volume at the NSE, around 45 to 48,000 crore in cash segment is contributed by these traders. Similarly, in FO segment, I remember a very interesting thing about the F&O when it was initially being introduced, and the NSE people were conducting workshops telling the investors that what are the benefits of trading in F&O and how it will trade, what are the mechanism. And at that time, I always had one question. They were saying that these institutions will be able to hedge their risk by taking position in the derivative market. And I was wondering that who will provide them these hedging opportunities. Today, you look at most of the positions are being taken by the retail investors in the F&O segment, and the institutions who are hedging. The institutions are actually hedging their cash positions or other open positions, but retail investors are having open position in the market. And this means that the retail investors have a good risk appetite. Now, with this thing in view, we are discussing, I thought that it will be proper if we can have spend some minutes on the what are the objectives of investment and how it happens, investment happens. So objectives of investment are basically two types in broader terms. One is long-term investment, where a person invests in shares to earn dividends from assets in which he has assets invested, or he waits for appreciation. He feels that fundamentals are very strong, this company will grow up, and then after the appreciation of the value of those assets, he will get money, he will book profits. Second objective is speculative. It could be day trading or holding position in F and open position in F segment for short period. I mean, he may carry it for a month, or he can carry for 2 months, 3 months by having a rollover. Now, one thing is there that whosoever is doing it, he has to think of few factors. First, what is his investment objective? And second, there is a concept of suitability of the client. I mean that if a person is a retired person, then day trading or investment in F&O won't suit him because there's a larger risk and he may lose his entire capital. But if a person is young and he is in a position to take risk, then perhaps he, in turn, in addition to making small investment, can also indulge in day trading or in the F&O, trading in the F&O where the positions are leveraged and people, they end up in making more profits or larger losses. The short-term traders are basically defined as who make trades that last for minutes, hours, or days, taking advantage of short-term fluctuation in the asset price of a particular security stock. And this involves active management with the short-term holding period. I mean, they will continue to look at the screen, they will looking at reading at various reports, and almost entire day they will spending in that. And even in the night, they will look at Nasdaq, what is happening in Nasdaq, how is happening, what is happening to Nasdaq futures and other things. And then they will able to make profits in the market. On the other hand, the long-term investing is that making trades that stay open for months and often for years. These are buy and hold trades rather than quick buy and sell trades, and they are based on well-researched reports. This involves passive management with long-term holding period. Now, what are from where these day traders gets the tips? They get tips for day trading from technical analysis. I mean, there are the people who are expert in technical analysis. They look at the price volume movement in the market, and from the charts, they forecast that what will be the trend in the market, what will the export levels, and what will be the export level for downside, and what will be export level for the in case the scripts goes up. And they also define the targets and stop loss. These technical reports of technical analysis are available in newspaper, on electronic media, and also you can subscribe to some of the portals to get these reports. Another interesting subject is the grapevine, where even in the Economic Times and some of the other newspaper, they will carry these reports. These are some information which is rumor based and not confirmed information, but sometimes it turned out to be true also. But sometimes the people take position and they are based on these rumors which are finally declined by the concerned parties. It recently happened where one bank was supposed to be merging with another bank, but the management of that particular bank later denied it in the newspapers. But the greatest risk is unsolicited investment advice. This unsolicited investment advice you often receive through social media, on WhatsApp, on Facebook, and through other channels. That is more dangerous because you are receiving it from an unconfirmed source, and the guy who is not actually registered with SEBI as a research analyst, he is passing the information, but he does not have any responsibility. This fellow Normally what happens that these guys flood you with this data, and reason for providing you unsolicited investment advice is that he may like to sell his YouTube portal, or he may like to sell a service like giving you advice, or he may be working for a broker to get new clients. So this is a very dangerous trend, and the people can lose money in this if they act on these unsolicited investment advice. So, like in pandemic, they say that stay home, stay safe. We say that invest safe, stay safe. So, what could be the various tips now coming to the actual tips which can help you in making investment and trading? First, decide your investment objectives, which should suit your compatibility as a client. Your investment objective could be that if you are a retired person, you want to put money in large caps, don't want to take too much risk, you are want this dividend as a regular income. If you are a young person, you may like to go for day trading and take a risky position in F&O. But one thing is there, you have to be disciplined. Disciplined in the sense, supposing you are a day trader, that does not mean that if you are having a profit making period, you book profit immediately. And if you are having a loss making position, you say, okay, I'll carry it. You turn yourself into an investor. So this way you will be losing money. So you have to be very disciplined. What is your approach? What is your objective? And you have to stick to that. Other general advice from every financial advisor is that distribute your investment among various classes of assets. If you have 100 rupees, distribute some in equity market, some in commodity, some in gold or precious metals. And of course, you have a lot of money, some you can put in real estate. So you distribute your entire investment. Reason being that I seen one of my, I was working with a company, and that company, we got few employees from E-Trade, and when in 2008, these guys had large ESOPs from E-Trade, and when in 2008 there was a subprime meltdown, the price of E-Trade share, it crashed from $30 to $1 in a single day. And now you can see what could have happened to those fellows if they had invested their money only in E-Trade. Other thing is, as I stated in the previous slide, avoid taking position on unsolicited investment advice. And last, if you do not have time or inclination, I mean, neither you have time to study the balance sheets, time to or aptitude to study the reports, nor you have the time to sit on the terminal and do day trading. The best is to invest through mutual fund. I mean, this is something I would say that in case you don't have time or inclination, then mutual funds say here. So all of us are normally looking for an investment avenue where our capital could be protected and where earnings could be there if market is improving. I remember that they in the year 2006-7 perhaps two such structured instruments were introduced by Citibank and DSP Merrill Lynch. I also invested in one of that instrument. The minimum subscription was rupees 3 lakhs. The idea was that these guys were saying that we will give you a guarantee that if you invest 3 lakhs, you will return 3 lakhs after 5 years. Minimum 3 lakhs after 5 years. But we will link your gains to the Nifty index. If the Nifty index improves and it reaches this and this level, we give you upfront commitment that we will give you these kind of returns. So when I asked them, how do you manage that? So I was told that they will put around 60% of money in the, I mean, what I say that the ventures and other thing of good companies where they will get a fixed return, and that way after 5 years our capital will be intact. And the balance mode they will put in F&O and other options and other ways they are more risky, but they will try to make money for the investors. And what happened that due to subprime, the Nifty index came down, but we were lucky to receive our money back. Now, the last thing is, I'm not making any conclusion on the hypothesis that do investors make money from tips. I keep it open. Maybe after you can decide on that according to your own opinion and whatever your take from this session. But one thing is sure, only waiters are sure to gain from tips. Thank you. Now we can take a few questions.
So thank you so much for the presentation.
Hello.
Hello. Sir, am I audible?
Can we take a few questions?
Sir, unfortunately, because we overshot the time and we have another webinar right now at 6 o'clock. So, sir, I request you to, if we could share your mail ID so that people can directly ask you the questions when needed. Or else we'll make a consolidated list of the questions that we receive on Pi and then send them to you.
Pardon? Sorry, I missed that because there were
unfortunately,
yeah.
because we've overshot the time and we have another webinar scheduled right now.
Okay, fine.
So, sir, if we could make a consolidated list of the questions and send them to you so that we can later on send in the answers to the respective viewers.
That will be fine with me. Okay, fine.
Thank you so much, sir. Thank you.
Thank you.
And thank you for the wonderful presentation, sir. It was very informative. Thank you, sir.
Thank you, dear. Thank you.